If any questions come up about that, as always, you could just let me know. And one other thing I wanted to point out, there are several videos related to inventory, which is our topic of Chapter 10. So if you go to the Accounting Stuff link under the Chapter 10 module, you will, if you scroll down to Chapter 10 on that page, you'll find all these different videos related to inventory. So you might find that useful because some of the inventory concepts get a little confusing, and these will help clear some of it up. So I think that's pretty much it here. Let us go ahead and get on with our chapter. Now, basically, when it comes to inventory, there are two types. I think you've heard this before. There's perpetual inventory, and there is periodic inventory. The difference is with the periodic method, you wait until the end of the period to see how much inventory you have, and then you can figure out the cost of your remaining inventory. But you can also then figure out what is the cost of the inventory you sold. So again, with the periodic method, you wait till the end of the period to do that. With the perpetual inventory method, you're perpetually calculating the cost of your inventory. So every time you make a sale, you record the cost of goods sold at that time and reduce how much inventory you have. And that way you always know your cost of goods sold, and it's more work with the perpetual inventory method, but you have a more accurate understanding of your inventory costs at all times. Now, within those two methods, periodic and perpetual, you have a variety of different approaches. We're going to learn about FIFO, LIFO, and the weighted average method. Those are the three most common. But you're also going to learn about the specific identification method. So really 4 different approaches under perpetual and the same 4 approaches under periodic. So it's a lot to learn. Okay, starting with the first exercise here. This company, we see their beginning inventory. They have 140 units, and we see the company's cost per unit. Then we see some goods that they purchased. They bought 240 units of the same product, but at a higher cost. Inflation. Sometimes costs go up. Then they sold some units. It says the cost per unit. Actually, that's the price that they sold it at. So that's not very clear. But we'll just ignore it. We really don't even need the price in this particular exercise. Then we've got another purchase of 220 units at a cost of $80. Okay. So again, let's just ignore that 125 since that's a price, not a cost. What we need to do is figure out the cost of goods sold. Is that right? We need to figure out the cost of the goods that are available for sale. So in other words, during that month, if you look at all the inventory that could have been sold, that was available for sale, what is the cost of that inventory? So that would include the beginning inventory, and it would also include any inventory that was purchased. So we're going to break it down that way, and we see 140 units of beginning inventory, and that costs $75 each. So we'll put 140 times 75. So that's $10,500 of beginning inventory, right? Then for our purchases, well, we have 2 purchases, and they were at different costs because, again, inflation. So we have to total up those costs for each purchase separately and then combine them. We can easily combine the number of units. It was 240 plus another 220, right? So that's a total of 460 units between the two purchases. But the cost, what I'm going to do is add another column here, like this, just so we can keep track. And we can say, let's make this calculator a little smaller. There we go, that's a little better. Okay, so we had 240 units at $77 each. 240 times 77. 18,480. So I'm going to put that right here for now, just to keep track of it. And then we had another 220 units at $80 each. 220 times 80, that's 17,600. I'll put that right here. And then I'm going to add those two numbers together. 17,600 plus 18,480. And I get a total of 36,080. Again, that's only for the purchases. So now if we add both columns, we get a total of 600 units that were available for sale during the period. And we get $46,580 as the total cost. So now we know the cost of the goods that were available for sale. Okay? Not that hard. It is a little time consuming. Double check those numbers and they look good. All right. Now at this point, I'm the only one on the call, so I'm not going to ask if there are any questions. We're going to move on to exercise number 2. Okay, this one's a little unique. In this exercise, we've got 3 different companies. E Company is a retailer, and they accept goods on consignment from our company. So anything that they sell from our company is on consignment, which means that they don't actually purchase the goods from our company. They just show those goods in their store. If a customer buys it, they share the money with our company. But if a customer does not buy it, if nobody buys it, then they can just return those goods to our company because the company never bought them. There's another company, S Company, and E Company actually buys goods from S Company. So they purchase the goods and then resell them in their store. Okay? Now what we have to do is go through these 5 different scenarios and figure out who owns the goods. Which of the 3 companies owns the goods? The first scenario, the goods have been ordered from our company. They've arrived and they are displayed on E's showroom floor at the end of the month. Who owns the goods? Well, the answer is our company. Because remember, E only sells our products on consignment. They don't actually purchase them. So if they haven't been sold, they're still the property of our company. The second example here is S Company. Goods have been ordered from S Company. So that means E ordered the goods. However, they're in transit. They have not arrived yet. And it says here that the shipping terms are FOB destination. Now, if you remember that, FOB destination means, well, FOB stands for freight on board. And destination means that ownership does not change hands until the goods reach their destination. So if they're still in transit, they still belong to S Company. So the answer here is S. Okay? Then, hold on 1 second. Are you sleepy? Okay, next we have C, goods ordered from R in transit with no stated shipping terms. Well, really, it doesn't even matter that they're in transit in this case, because remember, when E buys from R, well, actually, he doesn't buy from R. When he orders from R, they don't take ownership of the property. So whether they've been delivered or not, they're R's property. For D, goods were ordered from, they've been delivered. The shipping terms don't matter because they've already been delivered, right? The shipping terms only matter when they're in transit. So if the goods were ordered from S and they've been received, then now they are the property of E. And the last one, goods ordered from S in transit. So in this case, they have not been delivered. The terms are FOB shipping point. So with FOB shipping point, ownership changes hands as soon as the goods are shipped. So as soon as S ships out the order, it becomes the property of E, even before it's delivered. Okay, so in this case, E owns the property. So there we go, that's number 2. And moving on to 3. This one is a little unique as well. It's the only exercise like it. There's something called the lower of cost or market approach. Sometimes a company is able to base the cost of their inventory on the market value if the market value has gone down from when they bought the inventory. This is actually going to lower your costs and make you look more profitable. However, it is allowed in certain circumstances under GAAP. So this exercise is actually pretty easy. What we see is the cost that the company pays, and here we see the market value. Okay, and we have to look at each situation and see which is less. For the first item, item 1, the market value is lower. So we're going to use the market value of $35, multiply it by the 10 units that were purchased, and that's $350. For the second item, the cost and the market value are the same, so we'll just go with the cost. And 25 units times $20 each is $500. With the third item, the cost is lower than the market, so we're going to go with the cost. That's what the company actually paid. $6 per unit times 12 units equals 72. And then we'll just total them all up, and we get $922 is the total. So that's how you use the lower of cost or market approach. Again, this is the only exercise like this. Okay. Moving on to number 4. All right, here we've got a formula that's very useful. We'll see it. Beginning inventory plus your purchases equals your goods available for sale, kind of like we saw in that first exercise. And then when you subtract your ending inventory, the difference is your cost of goods sold. Okay, so this is a very helpful formula. It's also helpful to know you can reverse the last 2 lines of this formula if you flip them around and you take your goods available for sale minus your cost of goods sold. That will tell you your ending inventory. So you can use this in 2 different ways, this formula. Now what we have to do here for exercise 4 is fill in the missing numbers. Okay, so the company started with $10,000 in beginning inventory, added $25,000 in purchases, which brought them up to $35,000 of goods available for sale. minus the $7,000 that they did not sell, right? This is $7,000 that's remaining in ending inventory. And so what they did sell was $28,000 of inventory, right? Goods available for sale minus ending inventory is your cost of goods sold. Now notice their ending inventory for 2021 becomes their beginning inventory for 2022. Then they purchase $3,000 more of inventory, bringing them up to $10,000. So then we have to figure out what is their ending inventory. Remember, you could take goods available for sale, subtract cost of goods sold, and that gives you ending inventory. And then you could check that by saying goods available for sale minus ending inventory gives you cost of goods sold, right? So that's all we have to do for exercise number 4. And now we'll go on to exercise 5. Okay. Number 5. So here are the company's transactions. Again, they've got some beginning inventory plus 2 different purchases. And we see their ending inventory. What we don't know is what's the value of that ending inventory. And we're going to figure that out using 3 different methods. First, we're going to use FIFO, first in, first out, meaning the first inventory that came in is what you use to figure out your cost until all of that inventory has been sold, and then you would move into the next oldest inventory. Then we're going to use LIFO, and LIFO is the opposite. It's the last in, first out. So you're going to use the costs from the most recent inventory. Then once you've used that up, then you'll go on to the older inventory. And when you use that up, you go on to the oldest inventory. Then we will use the weighted average method. And in the weighted average method, you have to take the total cost of all your inventory divided by the total number of units you have of inventory to get an average cost. So, oh, and by the way, when we do this, the cost that we're using, like let's say we're using the cost of the newest inventory, that doesn't necessarily mean that the units we sold came out of the newest lot. So from an accounting perspective, oh, hey there, Jane. Looks like you're connecting. Hello, Jane. Welcome.
Hello.
We are on hi there. We are on exercise number 5, and you'll be able to hear the earlier ones later from the recording. And I was just explaining that in this chapter, we've got multiple approaches to inventory. There's FIFO, LIFO, and the weighted average method. And then there's one other called the specific identification method. So specific identification is the only situation where we have to identify which lot of inventory we actually sold and use the cost from that lot. With the other 3 methods, which lot the inventory came out of and which cost we're using are separate from each other. So we might have sold a unit out of the oldest lot, but we're using the cost from the newest lot, or vice versa. And it's just because it's easier to track it that way. You'll get the hang of it as we go through it. So just keep that in mind. When I'm talking about which inventory we sold in this chapter, I don't really mean which inventory we sold. I really mean which cost of inventory we're using, regardless of which actual lot it came out of. So in this scenario, there's only one product we're talking about, but there were 3 different lots. There was the original lot that they had at the beginning of the period. There was another lot that they purchased March 31st. and another lot they purchased October 15th, but it's all the same product, right? And since the cost per unit changed with each purchase, when we apply the cost, depending on the method we're using, we have to apply the right cost. But again, it has nothing to do with which actual lot the unit came out of. Okay, so first we're going to use the FIFO method, first in, first out. With the FIFO method, the first inventory we sold would have come out of the first lot, first in, first out. The next inventory we sold would have come out of the second lot, and the last inventory that we sold would have come out of the last lot, right? So you could think of first in, first out as also last in, last out. Which means that if we have 50 units left over in ending inventory, the cost of that inventory is going to be based on what didn't get sold, right? The last lot. So to figure out the total ending inventory, we're going to take the 50 units times the $15 per unit from that lot, and we get $750. That's the cost of our ending inventory. For part B, we're using LIFO. So with LIFO, the first inventory we sold would come out of the last lot. So the last inventory that came in is the first that gets sold, at least from a cost perspective. So we would have sold out this lot first, then we would have moved on to the older lot, and then we would have moved on and sold out of the oldest lot. So that means if we're doing a LIFO, the inventory that did not get sold, we would base on the oldest inventory at $10 per unit. So again, if we have 50 units at $10 each, we have a total cost of $500 of ending inventory. Okay? So that's how we apply FIFO and LIFO. This is assuming we're using the periodic method, and at the end of the period, we're looking back and figuring out what our costs were. Lost my internet connection.
Recording in progress.
Okay, great. So let's continue. Oh, that's my camera. Okay. All right. So this is where we were. We figured out the FIFO. Oh, I'm looking at the wrong document. There we go. We figured out the FIFO, ending inventory cost, and LIFO, right? And now we'll figure out the weighted average. With the weighted average, again, what we have to do is get the total cost of all the inventory and divide it by the total number of units. So again, I'm going to add a column here because it will be helpful. And if we had 150 units that cost $10 each, that's 1,500, right? But then we bought another 160 at $12 each. So 1,920. And then we had 130 units at $15 each. That's 1,950. Okay, we can add that all together. And we get a total of $5,370. So that is the total cost of our inventory. If we now divide it by the total number of units that we had available, we'll get our average cost per unit. And when we add up the number of units, we get 440. Remember, this is the ending inventory that didn't get sold, but we don't need to consider that. All we consider is the inventory that we had available to sell in the first place, right? We had our beginning inventory plus 2 lots that we purchased, altogether 440 units. So now we divide the total inventory cost by the 440 units, and we get $12.20 per unit. Now, if we take that $12.20, we multiply it by the 50 units that have not been sold, we get $610. So using our weighted average method, we get 610. Okay, so you need to add up your total cost of your inventory, divide by the total number of units, get the average, multiply that by the number of units you have in ending inventory, and that gives you the total cost of ending inventory. Okay, so Jane, let me know if anything needs clarification. Because there's so many different approaches to inventory in this chapter, it does get a little tricky here and there. So just let me know if you have any questions.
I will.
Okay, great. So now let's go on to the next one. Now this is related. In fact, it's the same data. What we are going to do now is figure out the gross margin or gross profit margin. Again, in all three, LIFO, FIFO, and weighted average. So the way we do that is we could take sales minus cost of goods sold, and that gives us our gross margin. Sales is going to be the same in all three cases because your inventory methods only impact the cost of the inventory. The revenue is not impacted. So we're going to take the total sales, subtract the cost of goods sold to get the gross margin. How do we figure out cost of goods sold? Well, we need to know total cost of all the goods that were available for sale. Then we can subtract the cost of what didn't get sold, the ending inventory, and then we'll know the cost of goods sold. Okay, so let's start with sales. We know that there were 440 units available, and we know that there were 50 in ending inventory that didn't get sold. So we could take 440 units available minus the ending inventory, and that tells us we sold 390 units. The exercise here tells us that the sales price was $25. So we multiply the number of units times the sales price per unit, and we see our total sales revenue is $9,750. So I'm going to put that here. And again, the same sales revenue is going to apply for A, B, and for C. Okay. Then for A, we are using the FIFO method here. And what we have to do is take the goods available for sale minus ending inventory. That will tell us our cost of goods sold. Well, goods available for sale, remember we calculated that up here. That was the total that we came up with for all the goods that we had available for sale. And they actually provided it for us here in exercise 6 as well. So we know what goods available for sale is, and it's the same in all 3 scenarios. What changes is the ending inventory that we have to subtract. So under FIFO, if you remember, going back to exercise 5, ending inventory was $750. So we're going to take the goods available for sale, $5,370, subtract the ending inventory of $750, and we get $4,620. That is our cost of goods sold. We can then subtract that from the gross margin. And we get $5,130. Okay? So it's not too hard, but it is a little easy to get confused with all these different numbers. So for B, we're doing the same thing. We're taking the goods available for sale minus ending inventory, which in this case was $500. So we calculated up here for LIFO. So 5,370 minus 500 is 4,870. We can subtract that from our sales revenue. And we get 4,880 as our gross margin. And then for C, the weighted average method, once again, we take our goods available for sale, 5,370. We're going to subtract the ending inventory cost, which was $610, using the weighted average method. That gives us 4,760. We subtract that from sales. And we get 4,990. Okay. Now, obviously, a company is not going to use all of these approaches. They're going to use either perpetual or periodic, and they're going to use either FIFO, LIFO, weighted average, or specific identification. And they would use that one method for the entire year. In fact, probably for multiple years. Just like we saw last week with accounting approaches, you don't want it with, accounts receivable. You don't want to change your bad debt estimate every year using a different method. You want to keep a consistent method, right? Otherwise it looks kind of fishy, like you're trying to hide something. And the same thing with inventory. You'd want to figure out what is the inventory method that seems to provide you the most accurate idea of your costs and your ending inventory values, and use it fairly consistently. You can, to some degree, adjust it to make yourself look a little more profitable or less profitable if you're trying to avoid taxes, but again, you wouldn't make that change all the time. By the way, welcome, Miguel. We are in, we're in the exercise set. We're just about to start exercise 7. And Jane, did you have a question? No? Okay. I thought you did. Okay. All right. Well, let's move on to exercise 7 then. Here we've got some journal entries, and this is actually going to be pretty easy because what we're going to do is journalize this first purchase, then journalize the second purchase, and then a sale. Now, this is using the periodic method. It does say here periodic. For the exercise set and the problem set, if it doesn't say whether it's periodic or perpetual, then assume it is perpetual because that is the more common method. Perpetual gives you a better idea of your costs and both the cost of what you sold and the cost of your ending inventory and the cost of each sale because you're tracking it perpetually. So that's what most companies use. It is more work if you do your accounting manually. If you have an automated point of sale system and inventory tracking system and accounting system, then it really doesn't make a difference because it does it for you. So most companies use the perpetual method. Some companies use periodic. So again, if it doesn't say, assume it's perpetual, but in this case, it says periodic. So with the periodic method, when you buy inventory, you debit purchases. If we were using the perpetual method, then when we would buy inventory, we would debit merchandise inventory. Okay, so that does make a difference in how you journalize it. And I think the reason for that is it has to do with how you track the cost. If you're doing periodic, at the end of the period, you're going to add up all of your purchases of inventory. Then you're going to subtract any purchase discounts and purchase allowances and purchase returns to get your net purchases. If you're using the perpetual method, all of those purchase discounts, returns, and allowances just reduce your merchandise inventory. So you don't really need a separate account to track it. It just is a credit to merchandise inventory. You might remember that from a previous chapter. So anyways, the thing to remember, if nothing else, is when you're using the periodic method and you purchase inventory, you debit purchases. And here we bought 300 units at $21 each. So we go 300 times 21 at $6,300. And in most business transactions, you pay for it later, so that would be a credit to accounts payable. Then on January 12th, we bought 200 units at $24, so that's $4,800. Debit to purchases, credit to accounts payable. Oops, I clicked on the wrong thing there somehow. Okay. Then January 16th, we made a sale. Okay, we sold 220 units, and the sales price is $40 each. So 220 times 40, so that's $8,800. Now, in this case, our customer is going to pay us later, so we have an account receivable, and we count it as a sale. But with the periodic method, again, we don't track our inventory cost at this time. So we don't record cost of goods sold. We don't reduce our merchandise inventory. We're going to do all that at the end of the period. So really, the sales transaction in periodic is very simple. It's just accounts receivable and sales, or cash if the customer paid cash. Okay, so if there are no questions on that one, let's go on to number 8. Now we're getting into the perpetual inventory method. And if we're doing this manually, we have to track how much inventory is in every lot. So I'll show you how we do this. We use these tables. So up here we have the data. We see we have some beginning inventory, then a purchase, then we have 2 different sales, and then we have some ending inventory. So we use this table down here This one is going to be FIFO, first in, first out, using the perpetual method. And notice we've got a group of columns here that have to do with goods that we purchased. The number of units, cost per unit, and then the total cost. And then we have cost of goods sold. Again, number of units, unit cost, and total cost. And over here, we have the inventory that's remaining. With these tables, I've tried to make it easier for you by putting a star where you have to put the data. So wherever you see a star like this, or asterisk, I believe, right? Yes, asterisk. You're going to fill in that field, but also the fields to the right of it as well. Okay? So let's go ahead and go through this first one, and then you'll see how it works. We start off having 800 units of inventory that cost $50 each. So again, that's remaining inventory that costs $50 each, and that's a total of $40,000. Okay. Then we bought 600 units that cost $52 each. So we go over here under cost of goods purchased, and we put 600 units at $52 each. So 600 times 52, 31,200. Okay, so that hopefully makes sense so far. Now the part that's a little different from what you might expect, we have to keep track of these lots separately. We have the original lot that we started with, and then we have the lot that we just purchased. So I'm just going to copy down this first lot and put it right here. And I'm going to copy the second lot and put it right underneath. So now we can see both lots together. Okay, we don't add them together, we just put them next to each other. Now we make a sale and we sell 400 units. Okay. Well, we'll put the 400 units here, but the question is, which cost do we use? Remember, we're using FIFO, right? FIFO is first in, first out. So we would use the cost of the first lot, which is $50 per unit. And that totals $20,000, which means out of the 800 units we had in that first lot, we sold 400, we have 400 remaining. So now we put the updated amount, 400 units at $50 each is $20,000 in ending inventory from that lot. And we haven't sold anything out of the second lot, right? Because we're using FIFO, we always use the cost from the first lot first. Okay? Little different than what we're used to. Well, then we've got another sale. This time we sell 350 units. Okay, so we put 350. We have enough units in that first lot to cover it. So let's go ahead and take it out of that first lot. We're doing FIFO, so that's what we're supposed to do. And so those units have a cost of $50 each. So we go 350 times 50, 17,500. So how many units do we have left over in that first lot? Well, there were 400. We sold 350 of them, so we have 50 left over. Again, they're $50 each. So that's $2,500 of inventory costs from that first lot. And we haven't sold anything out of the second lot. So again, we're just going to bring that down. Okay? So resist the temptation to add these lots together, and just remember we have to track each one separately. Now that we've reached the end of the period here, our total purchases Well, there was only one, so we can just bring that down. And our total costs add up here. So 37,500 is our cost of goods sold. If we wanted to know the cost of inventory remaining, then we could add those two together. But we don't have to do that. So there we go. Now we have completed this table using the FIFO method for perpetual. Next, we're going to do LIFO. All right, so it's a similar process here with LIFO. Okay. In fact, it starts out exactly the same because we start out with 800 units at $50 each, totaling 40,000. Exactly the same. We buy 600 at 52 each. That part's the same. That came to what, 31,200, I think it was. Yep. So it doesn't change here until we actually make a sale. And so far it looks exactly the same. Now, when we make our first sale, 400 units, and now because we're doing LIFO, we take it out of the last batch of inventory. So that's a cost of $52 each. Okay, 400 units, $52 each is $20,800. So now we still have the entire first lot. We didn't sell any of that. And we have 200 units remaining out of the second lot, which was $52 each, right? Because there were 600 units, we sold 400, so that gives us 200 remaining at $52 each, so that's $10,400. Okay. Then we make another sale, and we're selling 350 units. Well, here's the problem. If we're doing LIFO, we're going to have to clear out this lot first. So we're going to sell all 200 of those. But we sold 350. So that means we have to take 150 out of the first lot, right? Because we didn't have enough to cover 350. So we sold all 200 from the second lot and 150 out of the first lot. So 150 times 50, times 50, 7,500. Okay, so that leaves us 650 remaining out of that first lot. Again, at a cost of $50 each. And that comes out to $32,500. All right, so now when we add up our purchases, it's still the same 31,200, but our cost of goods sold has changed compared to the FIFO method. 20,800 plus 7,500 plus 10,400. So now we have 38,700 as our cost of goods sold. And here we completely sold that second lot. There's none of that left. So we could see the ending inventory is 32,500 from the one lot that remains. Okay, we've done the FIFO method and the LIFO method. Next, we're going to do weighted average. And let me just double check that final number there to make sure my calculations were all correct. That was 8 and 9. Yes, 38,700 is good. Okay, so now number 10, weighted average. Now, this is a little bit different. We don't track separate lots in the weighted average method. What we have to do is combine them and get an average every time there's a new purchase. So once again, we're starting out exactly the same because we have only one lot. So we have $40,000 worth of inventory. We make a purchase of 600 units. This part is the same at $52 each. Okay, but now where things change is our average cost has changed because we had a $50 cost from the first lot and a $52 cost from the second lot. So our average cost is somewhere in between those. And the way we figure that out is we take the total cost that we already have plus the total cost from the new purchase. We have a total of $71,200 in costs so far. Then we take the number of units that we had previously plus the number of units we just purchased to get our total number of units. And then the third step is you take the total cost divided by the number of units. So in this case, we get $50.86. So that is our new weighted average cost. Okay. We make a sale of 400 units. We use that total or that average cost we just came up with. So 400 units times 50.86 is 20,344. That means we have 1,000 units remaining, right? Because we had 1,400 and we sold 400. Again, our weighted average cost hasn't changed. It doesn't until we make another purchase. That means we have $50,860. Then we sell another 350 at the same unit cost of $50.86. That's 17,801. So that gives us 50 units left over, right? No, excuse me, 650 left over. We had 1,000, right? Yeah. So 1,000 minus 350 gives us 650 left over. At again the same $2.86. So 33,059 is our ending inventory. I'll double check that number, but our cost of goods purchased, again, is still the same. Our cost of goods sold is $38,145. Okay, so let's see. 38,145 and yep, 33,059. So that came out right. So that is how you use the weighted average method with perpetual inventory. All right, any questions on that? We are going to do in the problem set one other weighted average perpetual example because it does confuse students sometimes. So we'll see that again. Okay, let's go on to our last two exercise. Oh no, well, there's more than two. Oh, we have 16. Okay, these are going to go a little bit faster though. So our last 6 exercises, and then we'll cover some problems. Okay, so these are journal entries, kind of like what we did before, but this time we're using the perpetual inventory method. So again, with perpetual, when you purchase merchandise, it's a debit to merchandise inventory. And whenever you get a discount or allowance or something, it's a credit to merchandise inventory. But we don't actually have to do that in this chapter. So the purchase 300 units at $21 each. 300 times 21, so $6,300. Okay, then we have 200 units at $24 each, $4,800. Okay, then we have a sale, 220 units at $40 each. Like we saw before, that's $8,800 of sales revenue and accounts receivable. But because we're doing the perpetual inventory method, we have to also record the cost of goods sold. So which cost do we use? Well, it says we're using FIFO, right? First in, first out. So we would use the cost from the first lot, $21 per unit, and they're 220 units. So 4,620. Okay. Going on to number 12. Okay, these are journal entries. In this case, it's LIFO and it is perpetual inventory. So if we make a purchase, again, it's going to be a debit to merchandise inventory, and it's going to be a credit to accounts payable. And we have another purchase on March 15th. So let me see if I can just copy and paste. There we go. And then we have a sale. So that's going to be just like what we saw up above. In this case, it's accounts receivable. It's a debit. Then sales revenue. Then we have cost of goods sold. And we have merchandise inventory. Because again, we just sold the inventory, we don't have it anymore. So our merchandise inventory asset goes down. Okay, that's number 12. 13. It says a group of inventory items costing $15,000 had been omitted from the year-end inventory count. Oh, by the way, I didn't mention, even if you use the perpetual inventory method, where you always keep track of your inventory costs, you still want to, every once in a while, at least once a year, maybe even monthly, you still want to count your physical inventory to make sure it matches your accounting records, just in case something got lost or stolen or something like that. Okay, but this is saying that at the end of the period, at the end of the year, they counted the inventory, and there was $15,000 of inventory that they forgot to count for some reason. So that means inventory is understated. However, that happened at the end of the year. So the question is that going to impact the beginning inventory for that year? And the answer would be no. You know your beginning inventory because it's whatever carried over from the prior year. So making a mistake at the end of this year does not impact the beginning inventory from this year. So we're going to put no impact, none, and neither understated nor overstated for beginning inventory. Now, a mistake at the end of the year also does not impact the purchases you made throughout the year because you know what those purchases were. And therefore, the mistake at the end of the year also is not going to impact your goods available for sale because that was your beginning inventory plus your purchases. However, that $15,000 error is going to impact your ending inventory, right? Because that's where you made the mistake. And because they forgot to count some of the inventory they have, their inventory is understated. Now that $15,000 mistake impacts cost of goods sold, because remember, goods available for sale minus ending inventory is cost of goods sold. So there's a relationship there. So that $15,000 that ending inventory was understated is $15,000 that cost of goods sold is overstated, right? If one goes up, the other goes down. And number 14 is similar. Number 14, it says ending inventory was $86,000, but in the accounting records, it showed $68,000. So it was off by $18,000. So how is this going to impact the balance sheet and the income statement? Okay, well, let's think about this. Inventory, obviously, is inventory, right? So if you're off on your inventory count, then when you record your balance of inventory at the end of the year on the balance sheet, it's going to be off. And if you were, well, actually, in this case, it wasn't that they counted wrong, they recorded it wrong, right? Instead of typing in 86,000, they typed in 68,000. That's an easy mistake to make. So the accounting records are $18,000 too low compared to the actual inventory, so they are understated, right? Because the accounting records are lower than the actual. Now, merchandise inventory is a current asset. So that means your current assets are also going to be off by 18,000, which means that your total assets are going to be off by 18,000. And your retained earnings will also be off. I'll come back to that one. Now, remember that there's an inverse relationship. As ending inventory goes up, cost of goods sold goes down, and vice versa. So your cost of goods sold is going to be off by 18,000, but it's going to be overstated. Now, cost of goods sold is an expense. So if your expense is overstated, that's going to reduce your profit. Both your gross profit and your net income are going to be understated. And remember, net income is part of retained earnings. That's going to impact retained earnings in the same way. So that one mistake of putting the wrong inventory amount impacts all these different accounts, and they're all impacted in the same way except cost of goods sold, which is the opposite. So if these were all overstated, then cost of goods sold would be understated. Okay. Any questions on this one? All right, let's go on to 15. Oh, this one's nice and easy. So this company had net income of $125,000. And then they found an inventory error. They found that inventory was understated by $15,000, which tells us that net income would also be understated by $15,000. So to fix it, we need to add back that ending inventory. In other words, it's basically reducing our cost of goods sold, because what we're saying is, oh, I guess we didn't have that inventory, so that increases our cost. But then, oh, look, we found that inventory, so that decreases our cost. Right? If we find we didn't actually sell that inventory, then the cost of selling those items goes down because we didn't actually sell them. So I know it gets confusing, but in other words, to correct our net income, if the inventory had been understated, we have to fix it by increasing inventory, which also increases net income. Okay. So we end up with a corrected net income of 140,000. And then our last, oh gosh, they're 18? No, they're 17. My gosh, okay. All right, exercise number 16. Here we're doing an inventory turnover ratio. This is kind of like the accounts receivable turnover ratio we did last time. And so what we do to calculate it, we take cost of goods sold, just like it shows here, divided by your average inventory, and that gives you an inventory turnover ratio. So it's how many times does your average inventory fit into whatever is your cost of goods sold? Okay, so how many times does it turn over into that amount? And you want that number to be as high as possible, just like we did with the AR turnover ratio. So in this case, cost of goods sold is 722,000. To get our average inventory, we take our beginning inventory, add our ending inventory, divide by 2. And if we do that, in this case, we get 60,000. Beginning plus ending, divide by 2. Then we divide cost of goods sold by average inventory, and we get 12.03. So that is our inventory turnover ratio. Our cost of goods sold is 12.03 times higher than our average inventory. Another ratio that we will learn here is the number of days sales and inventory ratio. This is similar to the number of days sales and accounts receivable ratio we learned last time. The way we did that, if you remember, was we took 365 and we divided it by our accounts receivable turnover ratio. You could do that here, but the textbook wants us to do it a different way. They want us to take our average inventory, which we already calculated here is 60,000. Then we take our cost of goods sold, divide that by 365 to get an average daily cost of goods sold. So it's 1,978 and 8 cents. And then we take average inventory, divide it by that average daily cost of goods sold. So in this case, we get 30.33. If we had taken a shortcut, and let's say we just took 365 and divided it by our inventory turnover ratio, because of rounding, we end up with 30.34. So it's a little bit different. Okay, so it's fairly close, but not exactly the same. Okay, and the final exercise, we have some missing numbers. Remember this formula: beginning inventory plus purchases is goods available for sale, minus ending inventory is cost of goods sold, right? So if we're missing beginning inventory, we can just work backwards here and say goods available for sale minus purchases gives us beginning inventory. And then our turnover ratio, again, is going to be cost of goods sold divided by average inventory. So let's first figure out our average inventory. 8,500 is beginning, plus 9,400 ending. And we divide that by 2, 8,950. We take cost of goods sold divided by 8,950, and I get 10.18. Okay, the number of days sales in inventory. Well, we need cost of goods sold divided by 365. That gives us our average daily cost of goods sold, 249.59, right? Okay. Then we take our average inventory, which was 8,950, and we'll divide it by this number. I think was 249.50. Did I do that right? I might have put in the wrong number, so let's double check. Okay. Oops, no, we want 17. 3586, is that what we got? 30, no, yeah, I must have done it slightly wrong. So let's try it one more time. So again, we know our average inventory is 8,950. That number was right. We're going to divide that by average daily cost of goods sold, which was cost of goods sold divided by 365, 249.59. Yeah. 249.59. Okay. And that equals $35.86. That is the correct answer, 35.86. Okay. So just like last week, we want the turnover ratio to be as high as possible. That means we're minimizing how much inventory we're carrying. We want to have enough to meet demand, but you don't want so much that you're spending unnecessarily on inventory. So you want your goods sold to be as high as possible and your inventory as low as possible, which gives you a lower inventory turnover ratio. So you want that number to be as high as possible, but you want the number of days sales in inventory to be as small as possible. So that finishes the exercise set, and we do have some problems to get through. Any questions here before we go on to the problem sets? Okay, let's see. Okay, let me pause here for just a moment. Gotcha. If you want to go. Okay, so let's start with problem number 3 here. On this one, let's see, we are back to the periodic inventory method. We're going to use FIFO, LIFO, and weighted average. We see the transactions, and so first thing we have to do here, we have to figure out the ending inventory so that we can then subtract that from goods available for sale and get our cost of goods sold. We see the number of units is 900. That's the same in all 3 cases. If we're using FIFO, then the ending inventory, again, is going to be coming out of the last lot. That's going to be $27 per unit. 900 times 27 is 24,300. And then if we subtract that ending inventory from the goods available for sale, which they gave us right here, we get our cost of goods sold. 112,760 minus 24,300 ending inventory gives us 88,460. Okay, so that is our cost of goods sold using FIFO. And let's check that one. I think it's right, but let's make sure. 88,460, very good. Okay. Then for LIFO, the ending inventory is going to be from the first lot, so $22 per unit. And again, we have 900 units times 22 equals 19,800. We'll subtract that from goods available for sale, which again was this number. And we get 92,960. Okay, then weighted average. So in this case, we already know the total cost of the inventory and the total number of units. So to get our average, we will divide and we get $24.67. $24.67 times 900 is 22,203. Okay, that looks right as well. So we will subtract that from, again, the goods available. And we get cost of goods sold, 90,557. Okay, little time consuming, but we got it all done. All right, so those are the answers for problem 3. And I think 5 is next. Yes, number 5. Okay. For number 5, let's see. Perpetual inventory method, it says. And we're going to calculate sales revenue, cost of goods sold, and gross margin. Okay. Well, sales, it says that they sold 88 units at $75 each. 88 times 75. That's $6,600 of sales. Now, cost of goods sold, well, let's see, they had 105. Oh, actually, let's see. Actually, all we have to do here is think about which cost are we using. The first lot had a $40 cost per unit. The second lot had 42. Since it's FIFO, the first in is the first out. So we would use the cost from the first lot, right? So when we sell these 88 units, it would be at $40 each. So $3,520 would be our cost of goods sold. So what you need to remember is when you're trying to figure out the cost of what you sold in FIFO, you would take it out of the first lot. If you're trying to figure out the cost of the ending inventory, then you would take it out of the last lot because that was the last to get sold, if at all. So then we can take sales minus cost of goods sold. And we get $3,080 as our gross margin. Double check that one. 3,080. All right. And let's see what's next. Then we have 8. Okay, so 8 is journal entries. This one is fairly simple, but you will see we have to do some calculations a little later. Well, extra calculations. Okay, so first we buy some inventory, 165 units at $21 each, $3,465, right? Yeah. Then we make a sale. We sell 120 units at a sales price of $36. $4,320. Since we're doing the perpetual inventory method here, we have to also calculate the cost of goods sold. And we have only one lot at this point in time, which is $21 per unit. So we're going to take 120 units that we sold times the $21 cost, and that's $2,520. Okay. So then we purchase some more inventory. We buy 225 units at $27 each, $6,075. Okay. Then we make another sale. So here's where it gets interesting, because we sold 180 units. Which lot do we use now? Well, remember, we had already sold 120 units out of the first lot. So since we're doing FIFO, we're going to use the rest of the lots in that unit. There are 45 units remaining, right? So we're 165, we sold 120, so we have 45 units remaining from that first lot at $21 each. 45 times 21, that's $945. Okay, but remember, the sale is 180. So now we're going to have to take the other 135 units out of the second lot, which was at $27 per unit. Right, so that's our total 180 units, 45 coming from the first lot and 135 coming from the second lot. So that's 3,645, it looks like, 3,645. So now we add those together. That's 4,590 is the total cost for that merchandise. I also have to put in the revenue, of course. Looks like I forgot to do that. So this was 180 units at $39 each. 180 times 39, 7,020 is our revenue. Okay, so that one did get a little tricky because there were two separate lots. This is why it's easier when you're using the perpetual method to use that table and keep track of each lot separately. I think it's easier, at least. But so then when you journalize it, you already know what's the amount. In this case, we had to figure it out. Then we have a final purchase, 210 units at $33 and times 33. So 6,930. So are there any questions regarding this problem? Let's double check all these numbers. So we had 3465, 4320. I've even forgotten what problem we're on now. Is it 5? 8. Oh, 8. Okay. Alrighty, there's 8. Okay, 3465, 4320, 2520, 6075. 70, 20, 45, 90. and 6930. Okay, so we got everything right. And now we can move on to the next one, which is, actually we'll do 11, 12, and 13, and then we'll end on 16. Okay, 11. This is an average, a weighted average perpetual one. Numbers 9 and 10 before this are FIFO and LIFO, so you'll get to do those on your own. I guess you might, I don't know if you have a specific identification problem in here. Let me double check. Specific. Oh, maybe not. Okay. In the chapter, there are some examples, but I guess maybe not in the problem set. Okay, so again, 9 and 10 are FIFO and LIFO, so you're going to have to remember what we did or go back and refer to the recording or the textbook and go through and do 9 and 10 on your own. But 11, the weighted average method, since this one is a little different and confusing for students, I usually go over this one together. So here we have 240 units at a cost of $100 each. That's $24,000 so far. Then we make a sale of 160 units. So the only cost available so far is this one lot of $100 each, right? So that would be 16,000, which leaves us with 80 remaining out of that first lot at $100 each, and that's $8,000, right? Then we buy 520 units at 103. Okay, let's move this down. So 520 units at 103. All right, 520 times 103, 53,560. But again, when we're doing the weighted average method, what we now have to do is take our previous total plus our new total. So that's going to be 61,560. We're going to take our previous number of units plus our new number of units. So that'll be 600. And then we divide the total cost by the total number of units, get 102.6. So that is the cost, $102.60 per unit. Okay. Then we have another sale. This time we sell 400 units. And remember, the average cost does not change until we make another purchase. 400 times 102.6. Sounds like a radio station, right? So 41,040. Okay, and then since we had 600, we sold 400. That means we have 200 left over at the same 102.6. So 200 times 102.6, 20,520. You can leave here. And then we purchase some more inventory. We buy 400 units at $110 each. Since we made a new purchase, we now have, we'll have to calculate a new weighted average. 400 times 110 is 44,000. So we add the 44,000, the 20,520, that's 64,520. Divide that by the 600 units we have total. And we get 107.53. Okay, let's make sure everything's looking correct so far. So this is number 11. Yeah, 107.53, good. Okay, and then we have a final sale of 370 units. Now, our average cost is the 107.53. And multiply that by the 370 units, 39,786. I think we round off on this one, 39,786. Let me double check. Yeah. All right, which means we have 230 units remaining at 107.53. So that's going to be three. Okay. We'll round this one off to 24,732. Now we can add up and we get our total cost of purchases. That's 97,560. We can get our total cost of the goods that we sold. So 16,000 plus 41,040 plus the 39,786, 96,826. 96,826. Okay, let's double check these numbers. Everything looks good. Okay, so now on this problem, what you're going to do is take this cost of goods sold and, oops, we'll copy it and put it over here under cost of goods sold. We're going to subtract that from the sales revenue to get our gross margin. The sales revenue, we have to calculate as well. Let's add another column here to do that. Insert column, okay? So we had 160 units, we sold for 140 each. That is 22,400. Then we sold 400 at 142 each. 56,800. Then we sold 370 at 144. 370 times 144. 53,280. Now we can add all of those sales together to get our total sales. $132,480. So that's the number that goes right here. And a little tip for you, that same sales revenue is going to be used in problems 9 and 10. So you don't have to recalculate it. The sales revenue is going to be exactly the same for 9 and 10, okay? Now, all we have to do is take the sales revenue, subtract the cost of goods sold, which is going to differ in each of those problems. And we get our gross margin, 35,654. 35,654. Okay. So we're done with problem 11. Okay. For problem 12, what we're going to do is copy these three fields. And let me move it down so you can see it a little better. That was the average method we just used. I'm just going to paste the sales revenue, cost of goods sold, and gross margin from number 12. This is going to come from the end of number 9. Again, actually, it's going to be the same sales revenue in all 3 cases. If you want, you can go ahead and fill, oops, no, not like that. You could fill that in now. So you're going to put in the cost from numbers 9 and 10 and subtract them to get the gross margins. Actually, you'll have that information already in 9 and 10. So basically, problem number 12, you're just combining the results of 9, 10, and 11 so you can see them side by side. And you'll see how, although the sales revenue stays the same, using a different inventory valuation method changes your costs, which changes your gross margin. Okay. Now we have problems 13 and 16, and we'll be done. Okay, problem 13. In this situation, we have data for 2 years, and this is the same formula we saw before. Beginning inventory plus purchases is goods available for sale, minus ending inventory is cost of goods sold, right? The problem is, in the data here, there's a mistake. This ending inventory is incorrect. It's supposed to be $32,000. I mean, that's what the problem says. So to correct it, we're going to start with this number, which is correct. But instead of the $27,000, we're going to make our ending inventory $32,000, which is the correct number. So now to get our corrected cost of goods sold, we subtract we take goods available for sale minus our corrected ending inventory, and our corrected cost of goods sold is $184,000. So you see that by increasing the ending inventory to the right number, which was an increase of 5,000, cost of goods sold went down by 5,000, right? Because that's the way they work. Okay, and if 32,000 is our ending inventory in 2021, that becomes our beginning inventory in 2022, so we have to correct that as well. Then we add our purchases. Now our corrected goods available for sale is 220,000. So that also got changed by $5,000. And then our ending inventory is correct. Once we subtract that, we get our corrected cost of goods sold as 190,000. So you notice that by correcting the ending inventory, that corrected our beginning inventory, corrected our cost of goods sold, corrected our goods available for sale, and it corrected our final cost of goods sold. Okay. And our last problem, number 16. Okay, this one is a ratio problem. Here they've already given us average inventory, so that makes our life a little bit easier. To get our inventory turnover for 2022, we take cost of goods sold divided by average inventory. And we get 7.4. On this one, we're going to round off to one place after the decimal. Then to get gross margin, you take your sales minus your cost of goods sold. So let's do that. $73,750. To get number of days sales in inventory, you take your average inventory divided by your average daily cost of goods sold, which you calculate by cost of goods sold divided by 365. So in this case, it's 606.16. We'll take $30,000 divided by 606 points. So 49.5. Okay, we'll do the same thing for 2023. Get the average, to get the inventory turnover, it's cost of goods sold divided by average inventory of 35,000.9. To get the gross margin, we take sales minus cost of goods sold, 80,750. And lastly, we need to get our average daily cost of goods sold. 250 divided by 365 comes out to 663.7. So then we take 35,000 divided by 663.7, and we get 52.7. Okay, that looks good to me, but we'll double check it. Yep, there we go. All right, and we are on time. Are there any questions? No? All right, well, thank you for hanging in there with the technical difficulties. If you get stuck, let me know. Otherwise, remember, there is no class next week, but we'll be back the following week. So have a good spring break and stay safe. Bye-bye.